So we are told here on 1st January 2021, Painting sells an item of machinery to college for its fair value of 3 million. For its fair value of 3 million. The asset had a carrying amount of 1.2 million prior to the sale. So I can see I made some normal profit there of some 1.8, 3 minus 1.2. This sale represents the satisfaction of a performance obligation in accordance with IFRS 15, revenue from contracts with customers. Painting enters into a contract with college for the right to use the asset for the next 5 years. Annual payments for the right to use the asset for the next 5 years, annual payments of $500,000 are due at the end of each year. The interest rate implicit in the lease is 10%. The present value of the annual lease payment is 1.9. Already they have been able to discount for you. So the remaining useful life of the machine is much greater than the lease term. Ladies and gentlemen, I will first of all start by looking at the lessor. The lessor mean, the lessee, the lessee, the lessee, the lessee. I'll start first of all by looking at the lessee. So let's see, we can see something very important here. They have given us present value of the obligation. Remember that the lessee, ladies and gentlemen, at the end of the day, this lessee is obligated to pay the lease rentals. He has to pay. He has to pay. So what are you told in this case here to do with this lessee? First of all, give us the present value of his obligation because he'll be paying 500,000 every year. All right. So in this case, we need the present value of his obligation. So this present value of his obligation, we are told it's 1.9 million. I always like chopping off 3 zeros or millions. Yeah, I'm chopping at the 3 zeros. So the present value of this obligation is 1,900. Once you give me this present value of the obligation, the next thing, because ladies and gentlemen, remember, this is a sale and lease back. It's a sale and a lease back. Is a sale and lease back. So you can't tell me that this amount will be the right of use. No, there is a special formula of getting right of use, and I'll not apply that special formula here. Once you give me this present value of the obligation, the next thing I will do pretty fast is, no, before I even tell you what I should do, can somebody help me out? What do you think in this case here should I do as a good student? Once I've been able to identify the present value of the obligation, what do you think should I do next? Honorable Nick, you're a good student. Honorable Nick is telling me, Mwalimu, amortize. Mwalimu, amortize. Mwalimu, amortize. Great. Mwalimu, amortize. Mwalimu, amortize. Thank you very much. So I want to amortize. So then come and give us straight away an amortization what year? An amortization schedule. Give us right away an amortization schedule. Give us right away amortization what year? Schedule. Give us right away an amortization schedule. Give us right away an amortization. It's like just a normal loan amortization schedule. So give us amortization. This is very important. Give us an amortization schedule. So we have here. So 1, 2, 3, 4, 5. It's a 5-year lease. So give us the opening balance. Give us the opening balance. Give us the opening balance. Give us, in this case here, the interest. So we have the interest. We have, in this case here, amount paid. Amount paid. Amount paid. And then we have the closing balance here. We have the closing balance. Very easily. The closing balance. The closing balance. So can somebody talk to me? Can somebody tell me what is the amount to be paid on an annual basis? What amount are we going to be paying on an annual basis? Is there somebody who knows what amount to be paid here on an annual basis? What amount will be paid here on an annual basis. And they told us the amount to be paid on an annual basis, cut the 3 zeros. We are cutting the 3 zeros. It's 500. And this one is never debatable. It's 500,000. This is the first thing that I should do, the best thing that I should do. It's 500 that I'll be paying every year for this lease, How about the opening balance? What do you think should I always take as the opening balance? The opening balance is the total loan that you have given to this lessee. Total loan is the present value of the obligation. So the present value of the obligation is 1,900. Present value of the obligation is 1,900. Thank you very much. So do we have the rate of interest in this question? Do we have the rate of interest in this question? Where I can see you. Do we have the rate of interest in this question? Yes, the cost of capital. The cost of capital has been provided here. The cost of capital has been provided here. The cost of capital has been provided here. They have told us it is 10%. So this cost of capital provided here 10%. So please, could you kindly calculate the interest for the first year for us? So 10% of the loan, total loan, this gives me 190. This gives me 190. So then come and give me the closing balance. In this case here, we have 1,900 plus the interest minus the amount paid. Give me the closing balance. Somebody move very fast. So in this case here, Jen Kigo gives me a figure of 1590. 1590. Jen Kigo gives me a figure of 1590. So this 1590 is what we carry forward here, isn't it? I hope you're together. I hope you're together. The 1590 is what we carry forward here. So we have 1590 here. We have 1590 here. So 1590, could you kindly give me interest on this 1590? The interest here will be 100 what here? 159. 159. So we have here 1590 plus 159 minus what we pay in year 2. Minus what we pay in year 2. So what we have, ladies and gentlemen, for year number 2, we have here 1249. So we have here 1249. So this 1249 is what we bring here. 1249 is what we take there. So this 1249 is what we take there. So 1249, are you able to give me the 10%? 10%, 10%, 10%, 10%, 12% of 1249? That gives me 124.9. 124.9. All right. So then take this plus this minus what we are paying in the third year. Tell me what figure are we getting somebody? What figure are we getting somebody there? So according to, I would rather we have the decimal here because there are very few. 873.9. So we have here 873.9. So please come and take this here. 873.9. Please give me the interest, which is 10% of this amount, which will give me 87.39. So this plus 87.39 minus 500 gives me what figure? 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 So I'm being given here 461.29. So we have here 461.29. So this is what I bring here. This is what I bring here. 461.29. 10% of it is interest. 10% gives me 46.129. 46.129. So can somebody in this case, ladies and gentlemen, take this amount plus this amount minus the reduction in the obligation? Give me a figure, somebody. Give me a figure, somebody. So in this case here, we have 7. What here? 7.419. 7.419. They're saying 7.419. I don't know how they got it. I don't know how they got it. Just check. Because this is 46 plus 461. It should be coming to 407, 7.4, 7.419, right? Quite high. But those are rounding off errors, ladies and gentlemen. In this case here, we know that at the end of year, I hope this is the last year. Year 5 is the last year, isn't it? Is year 5 the last year? Is year 5 the last year? Yes. So if it's the last year, always the last one, you must amortize it to what year, somebody? You must amortize it to 0. If it is the last year, you must amortize it to 0. You simply write 0 there. There is no problem. You see, these figures here are quite close to the real ones. They're quite close to the real ones. So in this case, you leave it there at 0 exactly. At 0 exactly. Great. So, ladies and gentlemen, we have this present value of the obligation. That one is now okay. So what we need to do very fast then is to go ahead. One side we are recognizing an obligation, the other side we are recognizing an asset. The name of the asset we shall recognize in this IFRS 16 will be called here right of what here will be called right of use. So the asset, the least asset. The least asset we shall recognize is called right of use. And for us to get this right of use, ladies and gentlemen, we shall basically take the present value. If you remember, the present value of this obligation. Then we come and divide this by the fair value. The fair value. So this is the proportion. And then automatically we shall come and multiply this with what here? The carrying value of the asset. We multiply this with the carrying value of the asset. Carrying value of the asset. So is there anybody who was able to get this right of use? Is there anybody who was able to get? Remember one side we are recognizing 760, right? Thanks, Jane. 760, yes. 760 is correct, yes. Great. 760 is very correct. 760 is very correct. 760 is extremely correct. Okay. So this is what we have. 760, yes. This is what we have here. We are told on 1st January 2011, painting sells an item of machinery to college for its fair value of 3 million. So the fair value is 3,000 because I'm cutting the 3 zeros. The fair value is 3,000. So let me just write these figures here. That fair value is 3,000. Fair value is 3,000. And then they're telling us they are very fast that the asset had a carrying amount of 1,200. So in this case here, we have carrying amount is the same as CV, carrying value. This is 1,200 carrying value. And then they are telling us there that down there, down, they're telling us straight away that the present value of this, the last paragraph before required, the present value of the annual lease payment is 1,900. So present value is 1,900. Present value is 1,900. So then given this information, I should for sure be able to get the right of use. I should be able to get the right of use. I should be able to get the right of use. So the right of use here will be the present value that is here, which is 1,900 over fair value. Fair value is 3,000 times, in this case here, carrying value which is 1,200. And these students are giving me a figure of what here? A figure of 760. A figure of 760. A figure of 760. Now, ladies and gentlemen, remember the moment I get this 760, so this is a leased asset. So this leased asset, remember, it's as good as now belonging to the lessee. The lessee is the one who has the right of use. So the lessee shall depreciate it. So the lessee shall depreciate it. So the lessee is depreciating it. So in this case here, give us depreciation, which is always straight line. 3 marks really. So depreciation will be 760 over the lease life. Lease life is 5 years. So 760 divided by 5 gives me what amount? 760 divided by 5 gives me what amount? Depreciation 760 divided by 5 gives me what amount? Gives me 152. So this is very important for us. Very important for us. Very important for us. So then I would want you guys to do me a favor. Please go ahead and give us the extracted financial statements. Give us the extracted financial statements. Start with the extracted income statement. Start with the extracted income statement. Start with the extracted income statement. Extracted income statement, very, very easy. Extracted income statement, very, very easy. For the lessee, for the lessee, for the lessee, for the lessee, for the tenant. Lessee is the tenant. Lessee is the tenant. So give us extracted income statement. So we have here the extract or extracted income statement. Income statement. So we have our years 1, 2, 3, 4, 5. So what items, ladies and gentlemen, do you think am I going to capture here? What items do you think am I going to capture here in the name of the tenant? Remember, this tenant has the right of use. Has the right of use. Has the right of use. What items am I going to capture somebody? So we have the finance cost. I love that. We have the finance cost. Any other thing? Depreciation, yes. So in this case here, we have under expenses, our cost. So we have the finance cost. We have the finance cost. It's here. The interest is the finance cost. So we have 190, we have 159, we have 124, 124.9, I'm just copying these figures of interest. We have 87 point what here? 87.39. We have a 46.129. And then, of course, he's charging depreciation. He's charging depreciation. He's charging depreciation here. He's charging depreciation. It's an expense, remember, to him. It's an expense to him. It's an expense to him. It's an expense to him. Thank you very much. So come and give us, ladies and gentlemen, here, depreciation. Depreciation, what do we have here? Depreciation, the figure is here. Depreciation, the figure is here. The figure is here. We got it as 152. 152. It's straight line, remember? 152. Now, remember, before this guy was initially, before leasing it, this guy was the owner of this asset. And if he was the owner of the asset, he sold it. He sold it. So he must have generated, in this case here, some income. So in this case here, we have income. Can just come and put it here. It could also be an expense. Remember, if it's a loss. So we have an income. So in this case here, let's calculate the gain on disposal. Let's calculate the gain on disposal of the asset. Gain on disposal of the asset. Gain on disposal of this asset. Gain on disposal of the asset. So we say there are two methods. There are two methods. Remember, before this guy, I gave you a very good example of Uchumi Supermarket, which used to have its head office at Aga Khan Walk there. All right. They were the landlords. They sold it and leased it back. So they became tenants at the end of the day. But before they became tenants, they were the owners. So when they sold, of course, there must have been some gain, some loss. In most cases, a gain. So there was a gain on disposal. So this gain on disposal, first of all, if you're using the formula, you must give us the normal profit. Give us the normal profit. So how do we get the normal profit? Remember, this asset, its fair value, market, it's being sold at 3,000. The normal profit, we normally take the fair value minus, in this case here, the book value. Fair value minus the book value. So fair value minus the book value is the same as carrying value. So fair value here is 3,000. Is 3,000. The carrying value or book value is 1,200. So is there somebody who is able to see this normal profit? Is there anybody who is able to see the normal profit? Normal profit, Grace is telling me there is a figure of 1,800. 1,800. But now remember that this 1,800 must always be apportioned. The 1,800 must always be apportioned. Is there somebody who is able to remember? I mean, what criteria? What criteria am I going to use to apportion? If you remember, ladies and gentlemen, we have our apportionment formula. Not many students in this case here remember to do this apportionment formula. Remember the apportionment formula this time around, you use present value. Use present value. Use present value all over what here? Future value, all over future value. And then whatever we get, we multiply this with the normal profit. We multiply this with the normal profit. Whatever we get, we shall multiply this with the normal what here? With the normal profit. Whatever we get, we shall multiply this with the normal profit. With the normal profit. So then the very first abracadabra, we have, ladies and gentlemen, our fair value is 3,000. Our fair value is 3,000 minus our present value, which is 1,900. Present value, which is 1,900, all over fair value again, which is 3,000. Whatever we shall get here, we shall come and multiply this with our normal profit. Our normal profit we got up here, which is 1,800. Which is 1,800. Which is 1,800. Is there somebody who is able to give us this apportioned profit now? Is there anybody who is able to give us the apportioned profit? Anybody who is able to give us the apportioned profit? It is 660. It is 660. It is 660. So this apportioned profit is what you recognize because you sold the asset. You sold the asset. You realized a profit. So under your income, yeah, you can simply come and tell us gain on what here somebody? Gain on disposal. So we have here gain on disposal, So you only recognize it in the first year because you sold this thing from the first year and then you became a tenant. So in this case, again on disposal, we have a figure of 660. Of course, the other years we have a dash. Don't add anything. Don't add anything because these are extracted. These are just extracts. These are just extracts. Now, let me ask you a good question. Hey, you, my good students. Is there anybody who was able to pass a journal and they got the same answer 660? Is there anybody who was able to pass a journal and they got the same answer 660? Great. I'm surprised. Great, 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 great. So which one is better? Let's now agree. Should we be using the journals or should we be using this formula? Which one is better? Which one is better? Which one is better? Which one is better? Let's agree. Because I will not be using the two methods. Oh, they're all okay. Okay. They're all okay. Okay. So using the formula is very, very easy. Using the formula is very, very easy. Using the formula is very, very easy. So, ladies and gentlemen, that is it from the books. On the books of the lessee, that will be it. On the books of the lessee, that will be it. So then we look at I like in this case here, Oma. Oma is telling me that you know what, Mwalimu. At times in this case here, we could be asked to do what here. At times we could be asked here to pass a journal. So if we say we don't master the journal, fortunately, I've taught you both. Fortunately, I've taught you both. So let's look at this from the eyes of the landlord now. From the eyes of the landlord or the lessor. From the eyes of the landlord or the lessor. So the lessor, remember, the lessor does not own this asset. The lessor, in this case here, remember now he has given out the asset, so he cannot depreciate it. So the lessor, or before you go to the lessor, there's extracted balance sheet for this guy. Sorry. Extracted balance sheet. Extracted balance sheet or statement of financial position. Yes. So we have year 1, year 2, year 3, year 4, year 5, year 5. So we have in this case here, still this is the lessee, the tenant. So this tenant, ladies and gentlemen, remember he has an asset now. He has an asset now. So this asset, of course, will fall under non-current assets. So we shall have what we call the leased asset, or basically, if you are a bright student, you mentioned there, right of use. Remember at time 0, this present value, we have been able to get the right of use of this asset at time 0. Who is able to remember at time 0? Could we attempt? Yeah. Let's see here. So in this case here, right of use. At time 0, we got the right of use. Is there somebody who can remember what the right of use was? The right of use, 760. I know where my students normally get it wrong. They always start in this case with 760 here. No. Remember this right of use, it is 760 at time 0. So the whole of year 1, there is depreciation. Of 152. Thank you very much. This is Leonard. Thank you very much. 152, there is depreciation there. So 760 minus 152, please give me a figure here. 760 minus 152, please give me a figure here. So in this case here, we have here 608. So what do I do to get the new value for year 2? What do I do to get the new value for year 2? What do I do to get a new value for? Thank you very much, Leonard, again. Keep on subtracting depreciation. That's a free mark. Keep on subtracting depreciation, yes. Keep on subtracting depreciation. So could you kindly give me this figure? 608 minus 152. 608 minus 152 gives us what figure? 456. 456 minus 152. 456 minus 152. Because we are depreciating the asset, basically. So we have here 3 what here? We have 304. We have 304 minus 152. Minus 152. This gives me 152, All right. And then, of course, the last year must be what year? Must be 0 because the asset is being depreciated to 0. It's straight line. To 0, it's straight line. So that's a non-current asset that you will be able to recognize in the statement of financial position. The lessee now is the owner of this asset. He has to recognize an asset there, leased asset. What we shall be calling the right of use. Remember, this guy is recognizing 2 things. He's recognizing an asset on this side, and at the same time, he's recognizing a liability. So under a liability, this is a little bit tricky, but I was surprised because you guys are really working very hard. I was surprised that most of you were able to understand this very fast. So in this case here, this guy will come and recognize a liability, and liability will be 2 of them. So we have in this case here the non-current liability. the non-current liability, non-current liability. So under non-current liability, we shall have lease liability. Lease liability. Is there somebody, Joyce, are you able to tell us the first figure that you're going to put here, number one? So lease liability, I'll be able to check that. So the lease liability, non-current, it's futuristic. It's futuristic. You simply come to these closing balances that you have here. Don't recognize the first year. Don't recognize the first year, because the first year is payable within 1 year. Within 1 year. So we start from year 2. So this one is what we pick as our long term. Remember, under non-current, we're looking at long term, more than 12 months. More than 12. So we start with this here. So don't tell me to start it from year 2. We are basically picking it from year 1 as a long term. So the long term, we are there 1249, 1249, 1249. We have here 873.9. We have here 461.29. Then we have 0, and then we have 0, of course, here. All right. So that's non-current liability before I answer Nick. Now, from there, we shall be able to book now the current what year? The current liability. We shall be able to book the current liability. Let's book the current liability. Let's book the current liability. Let's book the current liability. So current liability, what do we have here under current liability? Under current liability. So current liabilities, what do we have? We have a lease liability again. The same name. A lease liability, a lease liability. So lease liability for year number 1, this is very easy. Very easy because I use the ACK approach. The ACK approach. I just take the ACK. So I'll take the first ACK. So like now the first, this amount, you know, from here to here, I can see some amount is being paid now within the year. So in this case here, can somebody give me this ACK? The ACK, you're taking this amount minus this amount. So in this case, somebody is giving me a figure of 341. A figure of 341 there. Next arc will be this minus this for the following year. So 1249 minus 873.9 for the following year. What do we have? For the following year, what do we have? 375.1. 375.1. And then the next arc, until you finish everything here, the next arc, you're taking this minus this. You're taking this minus this. What do we have here, ladies and gentlemen? What do we have there, ladies and gentlemen? For 12.61. For 12.61, for 12.61. And then, of course, last arc is this one here. Last arc is this one here. So this one minus this one gives me what figure somewhere there, 461.29. And then, of course, we have a Z. We have a 0 like that. We have a 0 like that. So are we together, ladies and gentlemen, up to here? Are we together? Are we together? Are we together up to here? Thank you very much. Now, I remember one time, and these are the things that really assisted me to be able to get some of the knowledge that I have today, especially the marketing knowledge. Those days when we were in the university, when we were doing, in this case here, CPAs, we used to be very aggressive. For example, somebody went and told me, Mwalimu, no, at that time I wasn't Mwalimu, be doing what here? Graphics design by the side. Website creation. So if you look at, for example, the earliest, before I became very busy, the earliest artwork that we used to put on Facebook, later on, some of these things we do when you are in the university, when you're studying like today, some of the things that you do by the side are the ones which will be able to assist you later. So like the initial artworks that we used to put on Facebook, ladies and gentlemen, were coming from what year? Myself, a skill that I learned long time ago. So you must have that urge to get new skills, which at times are even outside what year? Our CPA, outside our accounting. Get a new skill. You can even teach yourself how to cook better chapatis, better ugali. Very good. Now, ladies and gentlemen, when I was doing programming, I remember those days we used to call them, those programs, VB6. Nowadays, they've been replaced by Python and whatever. So anytime I could make a mistake, my teacher used to tell me, that guy is a great guy. He used to tell me that, you know what, for long, that you have committed ID10T error. ID10T error. You have committed ID10. And I believed that this guy meant ID10T error. Later on is when I came to realize that he has always been abusing me. He basically was calling me idiot. And what Honorable Nick is telling me is that, Mwalimu, even yesterday, you still committed an ID10T error. Yesterday, you still committed an ID10 error. Nick is telling me that the row for yesterday, row for yesterday, row for yesterday, that we never depreciated the row for first year. For yesterday, that we took, that was then a very, very big blunder. Can you kindly confirm whether we made that ID10T error yesterday? Or is it Nick? Or is it Nick in this case, he will never followed our, because I don't think really I can commit that kind of an error. I know right of use is a present value. You must, in this case, start deducting the depreciation immediately. We deducted, now you see now, Nick, you are telling me that I've committed an ID10T error. Nick, check and correct. Perhaps you're the one who took row for the first year. We must always deduct. We must always deduct. No, Leonard, no. Don't abuse the Nick. Nick is honorable. So the most important thing, ladies and gentlemen, is that Nick, you're the one who is on the wrong. That's check and correct. Check and correct. We must always, in this case here, come and do what here. Great. Now that is it. So from the books of the lessee, we've been able to do an extracted balance sheet. We've been able to do an extracted income statement. Great. So let's go to the books of the lessor. The lessor is the easier guy here. Books of the lessor. Books of the lessor. Books of the lessor. So the lessor in the income statement, extracted income statement, what is this guy going to recognize? Extracted income statement. What is he going to recognize? Year 1, year 2, year 3, year 4, year 5. What is he going to recognize this guy? What is he going to recognize this guy? Interest income. Interest income. So to the other guy, of course, this other guy, the lessee, to him, it's interest expense. But to this guy is the owner now. He is the one who has given out the list item. So he's the one like who has given out the finance. So to him, he's getting, go back to current liability kidogo, okay, I'll be able to do that. But for now, please come and give me interest income. Interest income, interest income. Interest income is this one here. So we have 190, we have 159, we have 124.9, we have 87.39, we have 46.129. Is there any other thing we'll recognize? Is there any other thing you will recognize in the income statement? Before I go back to David's question. Nothing, right? Nothing. So in this case here, go ahead and give us an extracted, in this case here, balance sheet. Do we have an extracted balance sheet for him? Do we have an extracted balance sheet for him? I think I must have lost most of you. Perhaps as I get to carry you up, ladies and gentlemen, this guy was talking about current liability. To get current liability, we're using the ACK approach, David. We're taking like the first year's current liability, we're taking this minus this. And then we write it in year 1. For year 2, we took this minus this, like that. Yes, this guy, remember, once he has given out his property to the lessee, just like the way you guys will do an apartment, or you'll do in this case here, for example, invest in government bonds. So in this case here, you have an investment, what year? Asset years. You have an investment years. You have lease investment years. You have lease investment years. So he owns, not owning the asset. He doesn't own the asset anymore. He doesn't own the asset anymore. It's like he sold it. He doesn't own the asset anymore. The person will recognize this asset there. So to him, it will be an investment. So we have lease investment. So we have here extracted statement of financial position. So then what we have, ladies and gentlemen, here, this of course is the balance sheet. This, of course, is the balance sheet. This is the balance sheet. So we have year 1, year 2, year 3, year 4, year 5. So we shall have under is asset here, we shall have non-current asset. So we shall be having what we call the lease investment. The lease investment, let me see how much will you want me to book in year number 1? How much will you book in year number 1? Lease investment, how much will you book in year number 1? Lease investment. And the non-current. Non-current is futuristic. Non-current is futuristic. All right. So lease investment, ladies and gentlemen, we have year 1 futuristic year. So we have here 1249. 1249. We have 873.9. We have 461.29. We have zero like that. And then we have the current asset. You can't call them receivables. No. You will still come and call them what here? Somebody lease investment. Lease investment. But because I'll be paid this in less than 12 months, now we use the ACK approach. We use the ACK approach again. The ACK approach, you're subtracting. You know, receivables, like for example, when you guys don't pay us fees in full, we expect to receive something from you. So out of the business you're doing as a college. But if we invest, if we talk of lease, that amount can't be booked and received. That's a different thing. That's a different thing. So is there somebody who is able to give us this acts very fast? Like this minus this. What are we seeing there? This minus that. Already we have those figures, by the way. It's only me who rubbed mine. So David, you can understand that concept here of current. I mean, current is receivable within 12 months. So you simply take the difference here. So this and this. So the second one will be this minus this, which gives me what figure, somebody? The second one from Jane Kigo, 375.1. And then we have, in this case here, number three, we are taking the third arc. Number 3, we are taking the third arc. Number 3, we are taking the third arc. Number 3, we are taking the third arc. What do we have here? Jen Kigo gives me 412.61. 412.61. Then we have 461.29. 461.29. The last one, don't tell me because I know it. The last one I know it will be 0. The last one I know it will be 0. The last one I know it will be 0. The last one I know it will be 0. The last one I know it will be 0. The last one I know it will be 0. So, ladies and gentlemen, at least for this concept of a sale and a leaseback, have you understood it? Have you understood it? Have you understood it? Have you understood this concept now? Difference between 1.9 and the 0.76, can I remember? This 1.9 and 760, can I remember? Can you kindly, Joyce, do me a favor? Are you able to take a screenshot of whatever question you're asking? I'm so sure it's a working, but you'd want to understand. Are you able to take that screenshot and then you send it on WhatsApp? Because I know we have here fair value. We have the fair value. We have the fair, but unless you want me to pass the journals, unless you want me to pass those journals, are they journals that you want me to pass? Are they journals that you want me to pass? The 760, where do we get 760? Moffat, I see your answer. Where are we starting from 1249? Moffat, look at this. We have what we call non-current. Non-current means what here? More than 12 months. More than 12 months. For the year 1, if you remember year 1, the figure we had there is 1590. That 1590, it cannot be non-current. It's not more than 12 months away. It's within the year. Actually, the end of the year, immediately end of the year. So that cannot be in the future. We are looking at the future obligation. Non-current means long-term, more than 1. So you begin from year 2, moving forward like that. Okay, I would really suggest that you look at the videos, Moffat. Maybe the first video will make sense. $760 was row. 1900 was PVO. Then I suppose what this great lady wants us to calculate here, to help her calculate, is this row. Is the row, the right of use. Right of use, when, remember this right of use, and normally, we've marked these things for so long. You mark these things for so long in CASNEB. So you'll get, imagine a scenario where there is no sale and lease back. There is no sale and lease back. It's just a normal lease asset. And then you get a student, I think it's out of passion. You'll get a student out of passion from nowhere. Nobody has told you that an asset was sold and leased back. So you get a student writing a formula. Present value, in this case here, over fair value, times in this case here, what you're carrying value, times carrying value. So you ask why. I mean, I think it's a student who never took time to understand. So in this case here, the present value has been given. Present value has been given as 1900. The fair value has been given as 3000. The carrying value has been given, I've forgotten the figure. The carrying value has been given here. The carrying value has been given here as 1200. So remember, this is painting sells an item of machinery to college for its fair value. The asset had a carrying amount of this prior to the sale. This sale represents whatever. And then we are told here, painting enters into a contract with college for the right of use of the asset. Painting, in this case, is the one that sold. And now they are entering into a contract, ladies and gentlemen, with this company called college for purposes of what he are using. So for right of use, so leasing. So it's as they sold, and now they want to use it back. They sold, now they are leasing it back. So it's a sale and lease back. So sale and lease back. And you can see, ladies and gentlemen, that the carrying amount is 1200. I'm cutting 3 zeros. The carrying amount is 1200. So in this case here, this is what we need to get that 760. So the present value is given 1900 over future value, not future, but fair value. 3000 times this 1200. That's how we got this 760. But I hope I've answered your question. 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 I can see what Sam is talking about. Sam, yes, you can copy paste those tables, so long as you just remember to use the right terms. To use the right terms. If you use the right terms, then that is okay. For example, when we go to the SO, we are talking of what here? Income, interest income. The other guy is interest what you expect? Expenses. You can copy. You can copy, yes. Difference between right of use and the present value. Of course, you can see in this case here that you can see in this case, ladies and gentlemen, that the present value cannot be the same as what here, right of use. You see, if it was a normal leased asset, if it was a normal leased asset, the present value of the obligation, if it was a normal leased asset, the present value of the obligation would have been exactly equal to what here would have been exactly equal to the right of use. If it was a normal lease. I mean, in this case here, there is nothing like lessor lessee selling these goods to each other and leasing back, nothing like that. Then the two would have been equal. But whenever there is a sale and a lease back, whenever there is a sale and lease back transaction, then this carrying value here has to be up. There is a special formula you use to get what we call right of what here? Right of use. This is a special formula for right of use, for getting right of use whenever we have sale and lease back. Thank you, Honorable, for making that question clear to me. Great. Great. So now I think, Joyce, at least you have seen some light there. They would have been the same if it was a normal lease. But if it's a lease, sale, and lease back, then they can't be the same. You have to calculate row using that formula. You must calculate row using that formula. Now, that reminds me something very interesting. Hey, you guys who are doing finance, 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 you guys who are doing finance. If, for example, ladies and gentlemen, you are given here, lease rental is 500. But this thing is payable in advance. It's payable in advance. It's payable in what year? It's payable in advance. It's payable in advance. It's payable in advance. All right. And then they have told you that N is what year? N is, say, 2 years. Let me just simplify this. N is 2 years. N is 2 years. N is 2 years. N is 2 years. Right. So if N is 2 years and the cost of capital is 10%, the cost of capital is 10%, the cost of capital is 10%, I would want, in this case, ladies and gentlemen, somebody to give me the present value of the obligation. Present value of the obligation. Let's see, abracadabra. Remember, 500 is per annum. Is per annum. This is per annum. Payable in advance. 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 Great. Thanks, Grace. So I'm giving you exactly because you guys did financial management learned at the advanced level, and you never passed in this case here, no, intermediate level, and you never passed in this case here by luck. You deserved it. And some of the things you did were these ones. Let me see. Let me see. Let me see whether there's anybody who will be able to get this correctly. Okay, so please give us the PVFA. Give us the PVFA. Give us the PVFA. Please give us the PVFA for 2 years. If there's somebody, Grace already says, because it's per annum, I'm going to get PVFA. Grace, thank you. Please give me PVFA. Okay, Grace has given me an answer, so I'm waiting to hear from the other friends. Please and be free to post your answers here. Unlike my teacher who used to abuse me, I never get to abuse my students at all, and I will never do it. It'll be crazy. It'll be crazy. I never do that. I can never do that. So don't feel like Mwalimu will say that you've committed an ID10T error. I'm not in that class. I'm in that class where I believe that learning is normally a continuous thing. There's nobody who has yet given me PVFA for 2 years. PVFA. Is there anybody who has given me PVFA for 2 years? I just want PVFA itself. PVFA itself. I just want PVFA itself. I want PVFA itself. 1.7 something. Okay. I'm giving you 1 more minute. Okay. Thank you very much. Thank you very much. Margaret, that's not PVFA. Margaret, that is PVF. You've done a good job. Now, ladies and gentlemen, this is what you are told in those days, during those days. when you are in the intermediate level, when you are young, right now, as much as you call me mzee, what I know, age is catching up. Hata nyinyi mtakuwa wazee. Na ile tunafaa kujua ni kwamba ujana ni moshi. Ujana inaisha haraka. Hai, Vero. Hey, within no time. International disaster. Sasa, angalia hapa. Tuko na, you know, this guy is going to make 2 payments, right? He's going to make 2 payments. These payments are being done in advance at the beginning. So we have got 2 years. So we have year 1, year 2 at the beginning. All right. So at the beginning of year 1, he does 500. At the beginning of year 2, he does 500. Beginning. Remember the way the cash flow statement has been made. How we normally talk of cash flows normally accrue at the end of the year. But now these are the beginning of the years. And you are told, if it's beginning of the years, then you need to come and revise. You need to come and revise this time statement, the time statement. So in this case here, the revised time statement. This is what you are told by your teachers. You need to come and revise here. You revise the time variable. You revise the time variable. How do you revise the time variable? By subtracting 1. Because these are advanced payments. Whenever they are advanced payments, you subtract 1 to give us the revised time. So in this case, it means 1 minus 1. This gives us what? So this money is paid at time 0. Time 0. It's paid today. It's paid today. So that you can use year 1. And then, of course, when we come here, the revised time, this will be 2 minus 1. So this gives me what? Somewhere there. This gives me 1. Please listen. Don't write anything. Don't write anything. Don't write anything. Don't write anything. So after you do that, then we have, in this case, of course, these are our cash flows. These are our cash flows. These are our cash flows. So, ladies and gentlemen, once you have the cash flows, then come and treat this. Let's treat this as if they're independent. Let's treat this as if they're independent. Please come and give me what we call PVF at 10%. Independent, we use PVF, not PVFA. PVFA. So what do you know of PVF at time 0? Time 0 is today. What do you know of PVF at time 0? Time 0 PVF is always 1. You can even use the formula. You can even use the formula. We know the PVF formula. We know the PVF formula is 1 plus R raised to negative n. So we know, ladies and gentlemen, then that PVF here will be 1 plus R is 0.1 raised to negative 0. If you try raising to this to the negative 0, could you kindly don't write anything? Don't write anything. Just give me this answer. 1 plus 0.1 raised to negative 0 gives me what figure? Somebody there gives me 1. It's only Jackie that I'm speaking to, seemingly. The other students in this case here, they're not able to follow. They are writing and we say they're not supposed to be writing. They're not supposed to be writing. So that is 1. How about when n now is 1? When n is 1, can somebody give me this PVF when n is 1? So it will be 1 plus 0.1 raised to negative 1. Please ensure that you are able to pick your calculator. Ensure that you are able to pick your calculator and raise it yourself. Vero, I'm not hearing you at all apart from the last time I saw you laughing. Me, I'm not seeing you giving me figures. 0.90, 91. 0.90, 91. 0.90, 91. So could we kindly then come and put this figure here, please? 0.90, 91. I know you have not understood anything, but can you kindly just write this, and then you give me a thumbs up once you finish writing. So what is 500 times this? 500 times this. 500 times 0.9091 gives me what figure, somebody? 500 times 0.9091 gives me what figure, somebody? 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 454.55. 454.55. So you come and add here. So this will be 954.55. So this is the present value over the obligation. Present value of the obligation. Could you kindly, in this case, I know you have not understood anything, but just write fast. At times writing helps. Write fast. Write fast. Write fast. Write fast. And once you finish writing up to here, so this is the total present value. So this becomes the present value of the obligation. Present value of the obligation. Present value right here. Present value of the obligation, of the lease obligation. Present value of the lease obligation. Present value of the lease obligation. Present value of the lease obligation. If you're finished writing up to here, could you kindly put your thumbs up like this? Put your thumbs up like that. Put your thumbs up. Put your thumbs up like that. Put your thumbs up. Thank you very much, Bill Monene. Great. This Bill has been able to write up to them. So whenever you are told that an amount is paid in advance at the beginning of the periods, you must always remember to revise the duration that you have there by always subtracting one. Otherwise, you get a zero. Now listen and listen to me very well. This is not the formula that I would want to teach you, my students. No, these are bogus formula. These are bogus formula. These are bogus formula. But for some reason, the advanced FR examiner prefers this PVF. He prefers this PVF. But I looked at the marking schemes. These marking schemes, even if he has given you the PVF, even if he has given you the PVF what year factors, you can disregard those ones and use PVFA. I realize he's giving the two. He's giving the two. So, ladies and gentlemen, come here. Method 2. So method 2, come and give me what we call the PVFA. PVFA. I like PVFA formula. Even if you wake me up at whatever time, I know that PVF is 1 plus R raised to negative n. That's PVF. Once you give me PVF, ladies and gentlemen, once you give me PVF, then I'll easily give you the PVFA formula, because it is always 1 minus this simple PVF. 1 minus 1 plus R raised to negative n. And then everything to be divided by who? Everything to be divided by R. Everything to be divided by R. Everything to be divided by R. So then I would want you guys to do me a favor. We know what our R is. So this will be 1 minus 1 plus 0.1 raised to negative n. Our n in this particular case, it's a 2-year thing. I use 2 years to simplify. It's a 2-year thing. So minus 2 like that. Minus 2 like that. Minus 2 like that. All right. And then whatever we get, we shall come and divide this by R. R which is what year? 0.1. R which is 0.1. R which is 0.1. R which is 0.1. R which is 0.1. So, ladies and gentlemen, then are you able to give me this PVFA? 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 So from your calculator, you say 1 minus, open bracket, 1 plus 0.1, you close. You say raised to minus 2. You say equals. Whatever you get, you divide by 0.1. Whatever you get, you divide by 0.1. And everybody will be counting the response. Everybody must give me answers. Everybody must give me answers. Everybody, like Joyce Wangare, she's very active. Abraham is always very active. Abraham is very, very active. 1.7355. Nick and Leonard, they are hyperactive, but now I've not seen them up to now. Nathan, yes, even Nathan is so active. Students who are very active, students who are very, very active, those students never fail, never fail. And I'll give you an example of some students that I know used to really be active, and they were asking so many questions like last semester. And now, ladies and gentlemen, listen. How do I get this present value of the obligation? Present value of obligation when there is an advance payment. Remember in the questions that CASNEB gives, they normally say that the lease rentals are paid in arrears at the end of the year. They're paid in arrears. So the present value obligation for the advanced payment, then I will take the lease rental, which is 500 multiplied by PVFA, multiplied by 1 plus R. You multiply this with 1 plus R. This is what you are taught. This is what you are taught those old days. When there is advance obligation, advance payment. So in this case here, we shall talk of 500 multiplied by this PVFA, which is 1.7355, multiplied by 1 plus R. Is 1 plus. So abracadabra, there is something I want us to derive at. Shall we be able to get the same answer like the one we got of 954 point something? Shall we get the same answer? There is something that I want you guys to understand. There is something that I want you guys to understand. There is something that I want you guys to understand. Ah, they're getting the same. They're getting the same. They're getting the same. So this is 954.25. 954 point. Andrew 954.25 or 5 something, 0.25. Now, I want you guys to do me a favor. Please remember, in my class, you must always buy a highlighter. In my class, you must always buy a highlighter. And the highlighters we normally use in my classes all through, even before this politics began, we always use a yellow highlighter. All the other highlighters in Takataka, it's only yellow highlighter. It's only yellow color which forms government. No, but remember, I started using this yellow thing even before UDA or whatever. So please, yellow highlighter, could you kindly highlight this entire thing? Yellow highlighter, could you kindly highlight this entire thing? Could you kindly highlight this entire thing with a yellow highlighter? It's only yellow that brings out things conspicuously in a way that you'll be able to remember them when you read later. No, we don't do politics, Nick. Totally, I don't do politics totally. I don't do politics totally, Nick. Great, 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 great. But this time around, we are very lucky because we happen to be having, at this level, so far, the ones who have spoken to me, I have 3 waziris, county waziris, 3 of them. From Kilifi, I have one from Garissa, is it Ibrahim or somebody, one from Garissa, and then we have another one from this other county. They're here, which is very good. It means as RCM Online College, you're making an impact. Our clientele is now really, we are attracting the who is who in this accounting fraternity. Great. So I don't know, but have you learned something here? Have you learned something here? Have you learned something? Have you learned something? Have you learned something? That 1 plus R, when it is for advance payment, payments made at the beginning of the period. Ibrahim is Mogadishu. There is another one from Garissa. From Garissa, who is Waziri Trade. Ibrahim is Mogadishu. Now, online classes are also having a bigger impact beyond Kenya. Beyond Kenya. I feel proud. Share method 1, I missed it. Please help Honorable Nick. Honorable Nick. Great. Great, great. So then from here, let's do a loan amortization schedule. Once I get this present value of obligation, I'll always do a loan amortization schedule. So go ahead and do a loan amortization schedule. Go ahead and do a loan amortization schedule. Go ahead and do a loan amortization schedule. So what do we have there? We have year 1, year 2. We have in this case here present value. That is the opening balance. So we have the opening balance. We have interest. We have interest, opening balance. We have interest, opening balance. We have interest. We have amount paid. And then we have closing balance. So are you able to feel this very fast? Let me give you 1 minute. I give you 1 minute. Yeah. So the most important thing is for us to appreciate that we have opening balance, which is this. But now because the payment is in advance, all right, to get the principal amount that we are going to use to calculate the interest, I will take 954, which was the loan outstanding at the beginning. But remember, 500 was paid immediately. So whatever I will get, I multiply with 10%, I get this. So from there, come and take this plus this minus this, which I'm not seeing my students giving me a figure there. So I'm being given 499.62. So we have here 499.62. So then come and put here 499.62. 0.62 like that. 0.62, 0.62, 0.62. Of course, it's because of rounding off errors. Otherwise, it would have been 500 exactly, because in this case here, there will be no interest being paid in year 2. So automatically, we can take this as 500. But just for, because you can't have negative interest, 49.62 minus 500 times 10%. Please book this as 0. Book this as 0. Book it as 0. And then the amount you're going to pay here is 500. So this thing is amortizing to what year? To 0 like that. To 0 like that. It's amortizing to 0. 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 So, ladies and gentlemen, that is it. Very, very important. At least I believe now, when it comes to questions of lease, if you get them in an exam, you should be able to shine somehow. Remember, it's not about getting everything, but shining. You shine somehow. So if you allow me, I will go to the next standard. Unless there is a question here, really. Unless there is a question here, really, I'll go to the next standard. So in this case here, for advanced payment, what have you learned? I've learned for advanced payment, I've learned to get present value of the obligation, where I will take the lease rental, like the 500, I multiply this with the PVFA, and then I will always remember to multiply these with 1 plus what here? With 1 plus R. I will remember to multiply these with 1 plus R. I will remember to multiply these with 1 plus R. With 1 plus R. With 1 plus R. Is that okay? So can I go to something different? Can I go to something different? Thank you so much. So I'm going to the most important standard called IAS 36. IAS 36. IAS 36, you impairment of assets. IAS 36, IAS 36, IAS 36 is what we call impairment of who? Of assets. Impairment of assets. Yes, Joyce. Joyce has a question. Joyce has a question.